Hello, welcome. This is Seewing. Today, I'm going to talk about the current state of the housing market from a high level, discuss the past 3 or 4 years, what has transpired. I'm also going to refer to three main sources of the information, which before I begin, if you see a lot of value, please like my channel and subscribe to my channel. I've got some very good charts to share with you. The three organizations, like I said, I'm going to cover just a little bit at the beginning is the Case-Shiller National and Composite Index. Then later on, I'm going to talk about what the NAR, the National Association of Realtors, what they are saying, and one other resource as well, which is the Freddie Mac resource. From a high level, we can talk about the housing prices. The Case-Shiller National Index shows a 2% year-over-year decrease in February. Again, everything is a lagging indicator, although right now is already in May, how time flies, right? But they only go up to a few months ago, these kind of data. Everything is, I want you to share with you the big picture, what's going on, the up and down of the housing market and all the related volatility that we all been experiencing. Yeah, very, very confusing market, right? And just on the one hand, we're getting overwhelming amount of data, sometimes too much oversaturation of economic and housing data. Sometimes a consumer is being so overwhelmed by this data, they don't know who to believe, who to trust. On the one hand, we have the clickbait YouTube video crash bros out there who will create a doom and gloom scenarios just to get some clickbait so they could monetize their channel, whatever. So to me, that's very unethical. I don't know how to do a clickbait doom and gloom headlines. Furthermore, I'm morally responsible. I only share concrete, real data based on the sources. Plus, again, I'm ethically and morally try to be above board. That's all I can do. Provide you a lot of good data so you can make an informed decision as an investor, as a primary home buyer. Hopefully, you appreciate that. Okay, and I've been doing it I've been a real estate investor for more than 30 years, and I consult with thousands of real estate investors over years to help them buy investment properties. That's what I do. I've gone through all the up and down, all the real estate cycles and everything else. And I own a lot of properties over everywhere in the US. All I can do is share with you my perspective, my experience. Hopefully you appreciate that. All right. And I spend a lot of time each and every video to prepare for this. And my time spent, I'm trying to create a YouTube channel to get more people to watch my videos to get educated in a real good, thoughtful way. Enough of that. Let me go back to the article at hand. Case-Shiller Index, they are one of the most reputable resource out there. They follow the housing data for many years. And these kind of trends right here, the national index month by month, seasonally adjusted Case-Shiller. They have tracked these past almost 20 years. Most of the housing data, the index is very positive. With some downturn, of course, the housing crash back in 2008 and the subsequent consequences of it, the following few years of it. After that, the housing market became very robust in the past 15 years. Then, of course, this index skyrocketed way up there during the pandemic when the Federal Reserve lowered the rate to a historical low of 3%. Then we have seen a massive amount of skyrocketing gold prices back in part of 2020 and throughout 2021 and the first half of 2022. We have seen some historical home rising prices and historical low interest rate. Then, of course, in the past 9 months, things went down due to the very sudden increase of the mortgage interest rate from last summer 2022 until currently. Now you see the big picture of the index indicated by Case-Shiller CoreLogic. All the measures of house prices year over year is just a slightly slowing up until this March. NAR, National Association of Realtors, reported median price down less than 1% year over year March of 2023 from March in 2022. And Black Knight, another very reliable resource of housing data information, they have reported a near up 1% year over year in March. And Freddie Mac also reported housing prices up a mere 1%. So very slight changes. So 1% and less than 1% is really no big deal. My opinion, the so-called correction is, to me, is very wild. Clearly, there's no housing crash, although there are several Western markets, Western region Like in California, for example, where I live, in the San Francisco area, yeah, we have seen more housing price volatility than other part of the country. But this is just a short-term volatility. Think long-term, down the road, things should adjust and correct down the road. But most people are the prisoner of the moment. I call it prisoner of the moment because they are so fixated on the short-term current volatility. They lose all perspective. Because I'm a long-term investor myself, I tend to think long-term. I don't really bother by negative headlines, inflation, recession, and crashing situations, and job market and war in Ukraine. So much negative information. Again, because I've been doing it for so long and I consult thousands of those investors within my network. I just tell them invest for the long term, ignore all these short term situations. Getting back to this, here's a year-over-year home prices by Case-Shiller, National Association of Realtors through March, and Freddie Mac. As you can see, this is 2019. Around here, up until here, or the pre-pandemic, when the pandemic occurred in the middle of 2020, when the Federal Reserve lowered the interest rate to historical low to 3%, we have seen skyrocketing home prices. As you can see, the blue line is NAR, the red line is Case-Shiller, and then Freddie Mac is the black dot here. The trends are seeing some huge uptake, especially in 2021, where home prices throughout most of the country, especially the Sun Belt, skyrocketed 30, 40, 50% appreciation in a mere 1 year, which is absolutely mind-boggling, absolutely crazy. But then, as we go through the first half of last year, 2022, the mortgage rate was still around 4 to 5%. All of a sudden, around July and August last summer, 2022, when the mortgage rate was steadily increased from 3 to 4 to 5 to 6 to 7%. This very shocking mortgage rate increase last summer. It caused demand to really stumble, demand for homes. Then we see a lot of pain throughout the last 6 months toward the end of the year. So demand and home sales and everything, prices have decreased single digit in some part of the country, double digit especially in California. But we have seen some uptick year to date, right? In the first few months, we have seen 6 to 8% appreciation nationwide 2023 as a result of the very low inventory and pent up demand. Here's so easy, as you can see, the median price changes. And then let's get back to the 30-year mortgage rate. The 30-year mortgage rate have bounced between 6 and 7%. So the following graph shows the graph for mortgage moves daily, which I discuss quite often on a weekly basis. I follow mortgage moves daily mostly, but then they are also Freddie Mac, and then they are MBA, Mortgage Bank Association, also have their daily mortgage rate changes you can find online as well. The mortgage news data shows mortgage rate since January 2020, before the pandemic, were then now recently, now the mortgage rate, I believe that as of today, I think 6.49%, mid fours on a May 11th, which is a few days ago, which is up 6% from 6% in early February. So early February, there was some nice dip. Was dipped as low as 5.99, you recall, back in a couple of months ago. But then thinking, mortgage rate have decreased below 6%, but that was a short-lived interest rate. Immediately thereafter, the mortgage rate went back up above 6%. This year, we have to expect that the mortgage rate is going to be 6 to 7%. Hopefully, maybe by the end of this year, we may see the interest rate will come down to 6%, maybe slightly below 6%. So that's my hope. We'll see. But this is the new normal. This is a new reality. So we have to deal with it. And we still see a lot of buyers out there. We're seeing bidding wars at many of the markets, especially the homes that are below the median price. A year ago, 2022, on a payment of $500,000 house with a 20% down payment and a 5.41% interest rate, a year ago, around May of 2022, the mortgage rate were in the mid fives. And based on this scenario, your mortgage payment would have been $22.49, principal and interest only. Now, the monthly payment for the same house, with housing prices up 2% year over year, and the mortgage rates at 6.49% as of this week would be 25.76, an increase of around a little bit more than $300, an increase of 15%. Just goes to show you the interest rate difference will make a big difference on the mortgage payment. That's why we are having a 40-year home affordability situation. So a lot of people are being priced out of buying homes. That's very unfortunate, especially people continue to wait. That may not, if you can afford to buy a home, you should buy it as soon as possible before things get worse. But some people just procrastinate. So the monthly payment keep on going up. Yeah, prices are going up right now, and it's very hard to time the market. It just doesn't make sense. Here's one quote by economist Len Kiefer, who will point out that having nearly 2 out of 3 mortgages with a rate of 4% or less and market rates over 6% isn't going to help with the inventory situation. That means people who are locked with a low mortgage rate, they are locked in. They are not moving. They're not going to sell their home at 3% mortgage rate to move up to buy a move up home at 6.5%. And that would be crazy, right? That's what's happening. Sellers are not selling. Right? 62% of the mortgages are under 4%. Isn't it amazing? Shocking. And 82.5% of all the mortgages have interest rate under 5%. If these homeowners move, their monthly payments will increase substantially. That's what's happening. We're moving into a historical low inventory, which is right now, for most part of the country, is less than 3 months supply of inventory, where 5 to 6 months supply of inventory is a healthy, balanced market. And we are not seeing that. So distribution of origination interest rate in fourth quarter 2022, a few months ago, these are all residential first lien mortgages in all 50 states. Here it is. 0.3% of all mortgages have interest rate of less than 3%. 38% of mortgages have interest rate of 3.4% or less. 20% of mortgages have interest rate of less than 4.5%. 9.4% of mortgages have interest rate less than 5.5%. And 8.2% of mortgage holders have a mortgage loan of around 6%. That's going to show you people refinance during the no historical rate, the refinance boom of 2021. People who bought homes a year and a half ago and before, they have locked in their historical fixed rate mortgage rate, so they're not going to get rid of the mortgages. If the mortgage rate will come down below 6%, maybe some of these homeowners may be motivated to sell their home and move up. That's what we are seeing right now. Active primary mortgages by interest rate. Look at this. So many people have mortgage rate, 30-year fixed rate mortgage of 2%. That's amazing. They probably have a FICO score around 800 or 850. Right? FICO score is anywhere from 350 to 850, right? And most people with credit have a FICO score around 700. If you have a FICO score of less than 680, you are not a prime buyer. You are not an A-class buyer. You're like a B or a C buyer. You have a FICO score of 680, 650. Those people are going to have a hard time getting a good loan. You can qualify. Anybody with FICO score 720 or higher, you can get the best rates. That's the game you have to play. Back to the chart here. This is mind-boggling, right? Because look at this. Many people have mortgages of 2.25%. 3.5 million people have mortgages of 2.5%. 8 million people have mortgages of 2.75%. This is mind-boggling. Mortgage debts or the asset. Low mortgage debts, they have an underlying asset attached to the low mortgage rate. That is their wealth building asset. I believe a good debt, like historically low mortgage debt, attached to the underlying collateralized by that asset, like a house that they own, especially people own the homes for many years, they have achieved massive amount of debt. So people have good debt, people have low cost mortgages, and they stay at their home for a long time. I don't care whether you're a primary homeowner or you're an investor. That's the key. Hold on to their asset, hold on to the house, hold on to the income property at the lowest possible mortgage rate possible. At the current rate, 6.5%, if you enter the game, into the housing market, buy a home for primary home purchase, or investment home, even at current 6.5% interest rate, you can always refinance later. And the rate will have to come down. They will come down next 6 months or a year or more. So you can always refinance. I mentioned this before. Take the interest rate, but you marry the house or you marry the income property. So as long as you stay in the house long term, 5 to 10 years or more. I don't care what other things you have heard before, but I will maintain this particular philosophy. Year over year, rent growth continues to decelerate. Now that depends. A lot of these rental rates or data is all like multi-units apartments nationwide. It's not specific enough. Single family home rental rates or in some markets has maintained itself or even slightly increased. But during the pandemic recent boom, skyrocketing housing prices also caused rents to increase dramatically. In many boom towns, in many Sunbelt markets like Florida and Texas and all over the Sunbelt areas, we have seen single digit and double digit rental increases, 30, 40, 50% in some specific markets like Miami or other parts of Florida and also in Texas as well. But rent is trying to catch up with the housing price appreciation. Still, it's a lagging behind. As you can see, the chart right here during the peak of the pandemic with the low mortgage interest rate and rising home prices, the rent has gone up. Look at this, astronomical level. Now the rent has subsided. The rate has subsided, not necessarily have gone down that much. It all depends on the sector. It all depends on what type of asset you're talking about. Like I said, single family home rentals have been pretty much maintaining itself. But there are so many people that cannot afford to buy a home these days. They are entering the rental pool, especially single family homes renting. Those rents are really pretty stable and with some slight uptick. But the real estate, the commercial industry have built up a lot of apartment homes, multi-units in the past few years. So there's a glut of the supply of multi-units, apartments over the country. Because of there's a glut, there's oversupply. Demand's not that great. On the multi-unit sector, the rent has gone down recently, but not the single-family home rental situations in many of the robust boomtown markets, the Sunbelt, Southern, South and Southeast, and the Western region of the U.S., the Sunbelt region. Does that make sense? As we conclude with my big picture data in the past 4 years, the conclusion of this article, also my conclusion, is that home prices are under pressure to increase, even with the higher mortgage rate, 6 to 7%. But I believe there are more people who are qualified to buy homes, even with the elevated mortgage rates, because they've been sitting on the sidelines way too long. They have the money. That's why we're seeing bidding wars and multiple offers, like 5% offers, 5 to 10% bid price over list price, right? Sales price. It's all about inventory. Low inventory versus affordability. The existing home sales will likely be down more year over year in April compared to March. The inventory will continue to go down because pending sales and new listings and existing listings has been falling month over month this year. It's a crazy market. My takeaway from this is we just hit the bottom. I don't think the housing prices will fall that much at all because of extremely low inventory. The homeowners are not selling because of lack of effect, and demand is still pretty good. Again, if you are a primary homeowner, if you can afford it, if you like the area you want to live in, if you want to live in the long term, who's to say you should not buy? As for real estate investors that want to buy a rental property, that's what I do. That's my space. But it's never a long time to buy because I'm buying income properties. I'm buying cash flow properties in good, affordable entry level markets, mainly in the South and Southeast, Florida and Texas. That's my personal favorite because you can cash flow with 25% down payment, single family homes to 4 units. Again, things are moving positively, absent any catastrophic events in the world. If you see value in its presentation, please smash the like button and subscribe to my YouTube channel. And finally, quickly visit my website below and drop an email into the form to subscribe to my weekly turnkey real estate investor newsletter. Once you join my free network, you will receive weekly market updates, investment opportunities, real estate education, and interviews, top industry leaders. Thank you so much for listening on this urgent real-time housing market changing situations. They on a weekly and daily basis. So it's a very challenging market, but think long-term and take action. Thank you so much. This is Seewing. Have a nice day. I will see you on the next video. Bye-bye.